that ordinary investors suffer from these sort of problems now?
Yes, a great deal actually. I mean, some of the best data is from the United States, where they've had self-invested pensions for a long time. So there's more than 20 years of data on what they call 401k pension schemes, where a lot of people are managing their own portfolios within their investments. And a company, Dalbar, did a fairly straightforward piece of research, albeit with enormous amounts of data, where they said, what's the basket of assets that these investors hold, and what return has there been in the market over that period, and what's the return that investors have actually achieved? Well, investors on average achieved half the return of the basket of assets that they were holding. So what's that all about then? Well, there were two answers to that. One, of course, is that they're probably churning their portfolios more than they should have been and incurring transaction costs. But the second was, it turned out that when you look at the patterns of trading in these portfolios, people were systematically buying at the top of the market and selling at the bottom. The presumption is that that's kind of emotion-driven trading, and it's on the basis of people see the market falling and they panic and they get out, and by the time they get out it's a way down the curve because they don't have any real information or timing advantages. In fact, they have significant disadvantages, and for this, in the same way, they see the market rising again, they say, yeah, I'll have some of that, and they again, because they're behind the curve, they end up buying quite close to the top of the market. And it's easily done. Look, we went through a little bit of a market fall last year. There'd been a lot of talk about the Americans turning off quantitative easing. There'd been a bit of a bubble in the American stock market because of that. And I'd got some money in a bunch of index ETFs, and I very much believe in buy and hold, and I mostly try and take my own advice. But I just thought, yeah, this really is going to plunge. So actually, I sold a bunch of those investments, and the market fell. I'd seen the market start to turn down, so I sold, and then I left it a while and waited till the market was starting to rise again, and I bought in again. And I was feeling quite smug and pleased with myself. I've actually managed to time the market, I thought. And then I thought, well, because one of the things I'm very big on is being honest with yourself about stuff. It's very easy to tell yourself comforting lies. So I sat down and did the maths, all right? And it turned out that I'd sold a little way down, not right at the bottom, but a little way down. I bought a little way up. The difference between the buying price and the selling price was almost entirely eaten up by transaction costs. I'd made a few quid profit, but it could just as easily have been the other way around. And I thought, if I preach this stuff all the time and I make those kinds of mistakes, it's a very easy trap to fall into.
Yeah.